Okay, Nike just dropped its Q1 fiscal 26 results, and wow, huge surprise beat.
Huge is right. The market definitely didn't see that coming.
No kidding.
Yeah.
So today we're diving into your source material. We want to figure out how exactly Nike pulled off revenue growth when everyone, even them, expected a slump.
Right. And what the signals are for what's next.
Exactly. Mission is to unpack the beat, the strategies behind it, and yeah, the headwinds that are still definitely there.
And that market reaction tells you a lot. It was fast because, look, the whole story kind of flipped.
Flipped how?
Well, this quarter was supposed to be about cutting inventory, maybe sacrificing sales to get leaner. So reporting 1% revenue growth, that's a big strategic signal.
A turnaround signal.
Precisely. But we need to look at the tension, right? This unexpected revenue number versus, frankly, the pain in their profitability and what they're saying about the future.
Okay, let's get into it then. Start with the headline numbers. It was a big double beat.
Yeah.
Earnings per share, the EPS, landed at 79 cents. Analysts were looking for what, silver 27 cents?
Just $0.27. That's, I mean, that's not just a beat. That's huge. Almost double.
It shows a massive disconnect between the street's thinking and what Nike actually delivered.
That gap is key. The EPS beat suggests they managed costs, like operating expenses, way better than anyone thought.
Okay. But you said the real story was revenue.
Yeah, I think so. That's what really shocked investors. Total revenues were $11.7 billion.
And $11.7 billion versus expectations of $10.9 billion. That's a pretty wide miss by the analysts.
Very wide miss.
So why was that the big surprise? Why the shock?
It all comes down to context, right? The turnaround context. Nike themselves, their own guidance, had basically prepped everyone for a mid-single-digit revenue decline.
They were managing expectations way down.
Exactly. They were signaling, look, we've got inventory issues, we're shifting channels, sales are going to take a hit. So instead of going down, say, 5%, they went up 1% on a reported basis.
Wow.
That single percentage point, it feels small, but shifting from expected decline to actual growth, that's a tactical win. But it immediately makes you ask, okay, what did it cost them to get that 1%?
Right, which brings us to the how.
Yeah.
What did they actually do? CEO Elliott Hill has this win now strategy.
Yep, focused on North America, the running category, and fixing the channel mix.
So where did the win come from this quarter?
Looking at the channels, it was clearly wholesale. That was the big engine. Wholesale revenues jumped 7% to $6.8 billion.
7%.
Yeah. And your sources suggest this wasn't luck. It was that strategy. Hill pushing hard to repair relationships with those big retailers.
Ah, okay. So it's retailers stocking up again, getting ready for big sports releases, holidays maybe?
That seems to be the main driver. And you see mentions of, the usual suspects like Dick's Sporting Goods, successful partnerships there.
But also new ones, like Amazon and Aritzia.
Exactly. Adding those new relationships.
Okay, wait a second. Adding Amazon. Isn't that kind of the opposite of what they spent years trying to do, pushing everyone to their own app, their direct channels, for higher margins?
Uh-huh.
Are they just giving up on Nike Direct for now?
Well, that's the core tension, isn't it? The paradox this quarter. They got the sales number looking better by essentially leaning back into their traditional lower margin wholesale partners.
So a strategic retreat almost.
You could call it that, and it really stands out when you compare it to how their own channels performed.
Which weren't great, I'm guessing.
Not great at all. The big weakness was actually in Nike Direct, their stores, and crucially, digital. Overall, Nike Direct sales fell 4%.
Fell, okay.
And Nike brand digital specifically, down a painful 12%.
12% down in digital. Ouch, after all that investment.
Ouch is right. It points to, some real challenges in execution there, maybe softer demand online, right, where they wanted the high margin growth to be.
So just to recap, they grew overall sales by relying more on external partners, the old model, but their own futuristic digital channel took a big step back.
That's the picture.
And how does this look geographically? Did the Win Now focus work everywhere?
No. The geographic results really show how bumpy this turnaround is. North America, which is home base and a key focus for Hill, was up 4%.
Okay, so some positive signs there. The strategy is having some impact.
Where it's most focused, yes. But
yeah,
that North American strength is kind of papering over serious problems elsewhere.
like China.
Exactly. Greater China revenues were down 9%. Make it 10% if you adjust for currency. That region is still facing major ongoing headwinds. Recovery there, still a work in progress, definitely not a Q1 win.
Right. And we can't forget Converse. It's technically separate, but part of the overall company financials.
And it was bad. Converse revenues dropped. Wait for it, 27%.
27%. That's not a dip, that's a collapse.
It's pretty disastrous. And management seems to know it. They noted new leadership is coming in for Converse. But yeah, a 27% drop. That alone is enough to worry investors. It shows there's still significant strategic weakness under the surface, even if the main Nike brand managed a tactical win.
Okay, this is where it gets, like, really interesting. Because that 1% sales beat,
Yeah.
it came at a real cost, didn't it? When you look at profitability, the margins got squeezed. Hard. Gross margin fell 320 basis points, down to 42.2%.
Which is a substantial drop.
And the bottom line, net income, down 31% year over year to $700 million. So you have to ask, was that 1% revenue growth really worth a 31% profit drop?
That is the central question this quarter. A 31% fall in net income, I mean, that's a massive number you can't just brush aside. And it flows directly from that tactical shift we talked about.
The shift to wholesale.
Right. The sources point to basically three main reasons for this margin hit.
Okay, let's break those down. This really gets into the mechanics of a turnaround.
So first off, lower average selling prices, ASPS.
Meaning discounts.
More promotions.
Exactly. They had to offer deeper discounts to move that product, both to shoppers and to their wholesale partners. They weren't just selling shoes. They were, like you said, clearing out inventory, probably using discounts to do it.
Okay, factor one, discounts. What's two?
Second, and it's tied directly to the first, is that unfavorable shift in the channel mix. We keep coming back to this.
Because selling through Nike.com versus selling through Dick's is totally different for profit.
Totally different. If they sell, say, a $100 shoe on their app, they keep most of that profit margin. If they sell that same shoe through a wholesale partner like Dick's or Amazon, the retailer takes a big slice, maybe 30% or more sometimes.
Right.
So selling less through high-margin digital and more through lower-margin wholesale, mathematically, your overall gross margin has to drop. It's almost unavoidable, even before you factor in anything else.
And the third factor, you mentioned tariffs, external stuff.
Yeah, tariffs. That hit the cost of goods sold, the QGS. These are those external headwinds they can't really control as easily.
Yeah.
But they had a huge impact this quarter.
How so? Remind us.
Well, you have to remember the timing. The inventory they sold in Q1, that stuff was bought and shipped months earlier, probably when global shipping costs and tariffs were still really high, especially tariffs on goods coming into North America.
Right. So they were stuck with high-cost inventory.
Exactly. High-cost, tariff-heavy inventory that they then sold using deep discounts through their lower-margin wholesale partners. You put all that together.
The margin squeeze was basically baked in.
Pretty much unavoidable under those circumstances, yeah.
But, okay, despite that margin pain, there's a positive sign on the management side, right? Inventory levels.
Yes, that's crucial. Inventories were actually down 2% compared to last year.
Which sounds small, but strategically.
It's a huge win. It shows that the pain, the discounts, the margin hit, it wasn't random. It was part of a plan. They're finally getting that inventory glut under control.
Cleaning out the closets.
Right. And now, hopefully, they can bring in newer products, maybe at lower costs eventually, stuff that's more relevant to what consumers want now. But, you know, CEO Hill was pretty careful in his comments.
What did she say?
He said something like, while they're getting wins under our belt, they still have work ahead to get to all sports, geographies, and channels on a similar path.
That quote really sums it up, doesn't it? It's not a straight line. Which probably explains why they're being cautious about future guidance.
Absolutely. They shifted to only giving quarterly guidance now.
Which tells you what?
It tells the market, look, things are too uncertain, too dynamic right now for us to confidently predict way out into the future. The CFO, Matthew Friend, even said progress will not be linear.
Not be linear, okay.
Yeah, meaning different parts of the business, different regions, different channels, they're going to recover at different speeds. What they're really saying is we need to stay flexible, and maybe we'll have to prioritize stabilizing sales over perfect margins again if we need to.
So focus on controlling costs where they can. Navigate those external things like tariffs.
Right. And on tariffs, the sources mention everyone's still kind of waiting for an update on that potential billion-dollar hit they warned about if trade issues didn't get better.
That billion-dollar number is still hanging out there.
It's the wild card, yeah. While the teams on the ground are focused on selling shoes and cutting costs, if some trade deal happens and those tariffs get reduced or removed, right. It's the difference between fixing things yourself internally and getting some help from the outside environment.
Well, the market seemed to like the immediate results, the tactical win, and the inventory progress. Shares popped, what, 3% after hours?
It did. Rewarded the stability, I think.
And they're still sending signals to shareholders. Buybacks, dividends.
Yeah, consistent there. Returned about $714 million to shareholders this quarter. That included a 6% dividend bump, which is nice, plus about $123 million in share repurchases. So even with the margin pressure, they're signaling they feel okay about their cash situation going forward.
Okay, so let's wrap this up. The core takeaway for you, the listener, seems pretty clear. Nike showed it can definitely pivot fast. It leaned back on wholesale to drive sales growth and beat expectations. That shows brand power, strategic agility.
Definitely.
But that transition is far from over.
Yeah.
That 1% revenue growth cost them dearly in profit. Remember that 31% net income drop. And their key growth engines for the future, like digital and Greater China, still sputtering.
Which raises, I think, the really important question going forward. They got that essential 1% growth by relying on wholesale restocking and heavy discounts, right? Which crushed margins. So how long can North America and maybe the running category carry that weight? When does that dynamic operating environment, as they call it, actually require digital in China to step up and deliver healthy, full margin sales again? Before the market starts thinking these tactical wins aren't really sustainable long term.
That divergence, that nonlinearity. Success here means pain there. That feels like the real story. It shows why turning around a giant company like Nike is never, ever just a straight line up.
Absolutely. Always more complex under the hood.
Indeed. Thanks for diving deep into the sources with us today.